Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for June 24. This is our disclaimer. Please read it at your leisure. To move forward, I will take it as read. So starting off with performance, the month of June was a strong month versus the index, outperforming the index by 60 basis points. For the financial 24 year, the portfolio also had a strong year, up 21.9%, outperforming the MSCI World Index by 12.1% for the year. As I mentioned, last month the portfolio underperformed a strongly rising index driven largely by a handful of stocks, which was Nvidia, Apple, and Tesla. And we don't own any of those shares, so effectively that's the reason why on a quarterly basis we are down 1% versus the market. And all in all, not a bad result given the strength of those three shares over the last quarterly period. For the month of June, the portfolio traded. We exited our position in Shell. We reduced our holding in Brookfield Corporation. We sold Taiwan Semiconductor Manufacturing Company, the ADRs there, back to target 5%, so we reduced those. And also we increased our weighting in Amazon and Alphabet. At the end of the period, we held 13 shares and 15.5% in cash. This is just a graphical representation of the portfolio's performance since inception. As seen on the table there, we have averaged 16.3% per annum compounding over more than 5 years versus the index up 10.9% per annum. So today, instead of talking about a stock, I want to talk about growth because this is sort of being a little bit ignored by the market. The market's focusing very much on inflation and what inflation means for interest rates. But we're seeing that growth is a bigger risk to the market than inflation or sticker inflation. So look, it's not surprising that equity markets are forward-looking animals and they're already preempting interest rates, and that's seen market multiples expand quite meaningfully, and they are now in the top decile. And the big question from this point moving forward is that will valuations or share prices fall faster than earnings growth pick up to justify the current share price or the current level of valuations? We believe there is a significant chance that this will lead to a meaningful correction. In other words, that earnings growth that drives share prices will not basically justify the current share prices that we're seeing at the moment in the market. While obviously falling interest rates will reduce the cost of equity and the hurdle rates for equities, we still believe that there's a lot priced in the multiples. And this is already happening at the stock level, in the sense that you're seeing that the market is running out of steam to a degree. Again, it's being very much driven by a handful of AI-related mega cap companies. And this is being just shown by the extremely weak breadth in markets, which I also talked about last month. But this chart here is a better chart than what I put forward last month. It looks at the relative performance of the equal weighted indices versus the reported indices, which are cap weighted. And if you look at it on an equal weighted basis, the S&P 500, the equal weighted S&P 500 as a function of the reported S&P 500 index, the yellowy mustardy colored line, is falling to lows, and also the same for the NASDAQ equal weighted index as a function of the reported index, also falling to recent lows, being the blue line. So again, very much just attesting to the very weak breadth in markets that we're seeing. And the thing is that the market is basically rewarding bad news because it's bringing forward the prospects of rate cuts. But at the moment, there is a real risk that the growth scare could be large enough that the market actually sees it as bad news, not good news. And here we've got a chart of the Bloomberg US Economic Growth Surprise Index, and it's hitting new lows. So essentially, the market data coming out, especially with respect to growth, is essentially not meeting expectations. So as I mentioned before, the S&P 500 has been rewarding bad economic data for the prospect of it bringing forward rate cuts. But at the moment, we see that there's a risk to that that growth won't generally substantiate the current level of share prices, and also that the ongoing policy mix of heavy fiscal stimulus and tight interest rates is unsustainable. Something has to break. So accordingly, we've positioned our portfolio thusly, and I mentioned before that we're carrying a lot of cash. We've got a relatively defensive position. And this is because we believe that there'll be continued weak market breadth. Growth will not surprise to the upside to broaden the rally in markets. So essentially, we believe that market breadth will not expand, and essentially, eventually, stocks like Nvidia, Apple, and Tesla will start to lose steam. We're positioned for a market correction accordingly. So as I mentioned, we're carrying a fair degree of cash, a lot of dry powder. We're not looking for an implosion in markets, but essentially we believe a 5 to 10% correction is more than likely, and we are accordingly priced, accordingly positioned for that. We're also positioned in stocks that we're still seeing fundamental value in. Again, we are a fundamental manager. We are GARP. We're growth at a reasonable price, if you had to put a label on us. But we're invested in stocks that have long runways of organic growth that can compound out their earnings, and also that they have pricing power, and they're not reliant on a strong economic backdrop, that they're essentially got. They're largely masters of their own destiny. Furthermore, we're also avoiding cyclicals. One of the reasons we also exited Shell. The Shell had done reasonably well for us, but effectively a weak growth backdrop is not good for commodities. Also, especially with what is happening in the Chinese market, also not supportive for commodities. So we're avoiding lower quality companies, smaller cap companies, and cyclical companies. And as I mentioned, also we're holding a lot of cash. We've got 15.5% in the portfolio. That's cash, keeping our powder dry for opportunistic purchases at lower prices, and we're keeping an eye on our shopping list. And hopefully we'll be able to deploy that cash relatively soon. So look, that's the update for the period. As I've mentioned before, always, Tony and I are available for a chat. Phone numbers are on the bottom of this page, or otherwise, please contact on the Adansonia Capital Inquiries line. Anyway, that is that. I think I will be speaking to you guys again in a few weeks, having a chat to Rob on the quarter. Otherwise, I will be in touch again next month. And again, thank you for your continued support and interest in our portfolio. Thank you.